You know what's wrong with most breakout indicators? They show you the breakout after it's already happened. By the time you see the signal, smart money's already positioned and you're buying the top. And that's exactly why you need to see this indicator that reveals buying and selling pressure inside the channel before price even breaks. In this video, I'm going to reveal this indicator to you and how to use it to spot breakouts. Let's get into it. First, head over to TradingView and pull up any chart you want. I'm using the 15-minute time frame on GBPJPY, but this works on any market, any time frame. Click on indicators and type in volume sentiment breakout channels. Make sure you select the one by Algo Alpha. Now, this isn't your typical breakout indicator that just draws boxes and hopes they break. This is much better. It builds on two layers of logic that work together. First is channel detection, a volatility-based algorithm that locates price compression areas using normalized highs and lows over your look-back period. These boxes mark accumulation or distribution ranges. But here's where it gets powerful: the volume sentiment profiling. Each channel is internally divided into small bins where volume is aggregated and signed by candle direction. This creates a granular sentiment map, showing you which price levels inside the box are dominated by buyers or sellers. So when you see green gradients, you know there's net buying pressure. But when you see red gradients, it's a signal there's net selling pressure, and the intensity of the color tells you how strong that pressure is. Now, just before we get into settings, if you're a serious trader trying to become profitable, you need serious tools. Tools that use AI and multi-time frame confirmation to provide the best signals, whilst providing optimal profit targets, so you can catch the best moves across any market. That's exactly what our indicators do automatically. And the best part? They're currently 100% free if you click this link in the description below today. Now let's get your settings right, because this is where most traders mess up. Double-click on the indicator to open the settings panel. First, you'll see normalization length, which controls how the algorithm detects consolidation zones. For fast-moving markets like crypto or intraday forex scalping, use shorter values between 50 and 80. This makes the indicator more responsive to quick compression areas. For smoother transitions and swing trading, go longer, anywhere from 100 to 200. This filters out minor consolidations and only highlights significant accumulation or distribution zones. Next is box detection length, which controls how sensitive the channel formation is. It's set to 14 by default. Lower values create more boxes but with less significance, but higher values mean fewer boxes but stronger conviction when they appear. Keep this at default unless you're specifically hunting more or fewer signals. After that, enable the strong closes only if you want cleaner, higher quality breakouts. When turned on, the indicator only triggers breakout signals when a candle closes strongly beyond the channel boundary, not just wicks through it. This dramatically filters out false breakouts. Once that's done, click OK. Now let me show you two ways to use this indicator, each one more powerful than the last. For breakout entries, this is where the indicator truly shines. First, you want to wait for a clear consolidation box to form on your chart. The transparent box will appear showing the channel boundary with sentiment gradients inside. Next, watch the sentiment percentage display. For long setups, you want to see the current sentiment climbing above 60% bullish. This means more buying is happening than selling inside the channel, a signal that institutions are accumulating. For short setups, you want sentiment below 40% or showing majority bearish pressure. When price approaches the channel boundary and you've got strong sentiment backing that direction, watch for the breakout arrow. A green upward arrow appears when price breaks above with bullish sentiment confirmation, but a red downward arrow appears when it breaks below with bearish confirmation. Enter your trade on the candle close that triggers the arrow. Place your stop loss inside the channel at the opposite boundary and target at least 1.5 times your risk. For sentiment divergence trades, which catches failed breakouts before they happen, watch for price approaching the top of a channel, seemingly ready to break out bullish. But before you enter, check the sentiment reading. If it's showing only 25% or 30% buying pressure, that's a massive red flag. Price might touch resistance, but it's likely to reject hard without conviction. That's your short entry, right at the channel resistance with tight stop above. Just before we get into the best settings, don't forget to claim 100% free access to our AI indicators that catch the best moves across every market and time frame. Get instant access using the link in the description below before it's too late. But these strategies only work their best when you've got the perfect settings for your specific market. For forex pairs, especially majors, set your normalization length between 100 and 150. Forex has a lot of institutional noise and false compression zones during off hours, so these longer settings filter those out effectively. For crypto, you need much more aggressive settings because of the volatility. Drop your normalization length to 50 to 80. Why? Because crypto consolidations happen fast and break faster, so you need fast response to catch these quick accumulation zones before they explode. Also, expect more rapid sentiment shifts. A channel can go from 17% bullish to 90% bullish in just a few candles when whales start accumulating. For stocks, bump your normalization length to 120 to 180 for cleaner channel detection. Stocks move more methodically than crypto, so you can afford longer look-back periods. For gold, set normalization length around 100 to 120. Gold has unique volatility characteristics, periods of tight consolidation followed by explosive moves. I also strongly recommend enabling strong closes only for gold, because gold is notorious for false breakouts and wick traps. Thanks for watching, and I'll see you in the next one.